Joining me now is Richard Saperstein. He's the CIO at Treasury Partners. Richard, welcome to the show.
Thank you.
So a lot of excitement for StubHub, but also a lot of anticipation for this Fed meeting. What do you think is going to happen at 2 p.m. today?
Likely 25 basis point cut, an indication of 2 more cuts this year. But I think it's important to recognize that there's must-do policy changes and can-do policy changes. In this case, it's a can-do. If we look back to 22 when we had raging inflation, we had must-do policy change. We had to tighten rates very significantly. Markets interpret it differently. In this case, we have a can-do policy change. After all, employment is slack a little bit, but not really dropping tremendously. Inflation's trailing lower, so the economy's strong. Not a must-do cut, but I think we're going to get a can-do cut.
So some people I'm speaking with think there might be a 50 basis point cut. What are your thoughts on that? Do you think they can go that high?
They can do anything. I think what's built into the market is 25, but empirically the Fed is always behind the curve. So stocks are moving because of other reasons other than the Fed. This could only add a little bit more juice to the environment we're in for stocks.
And Fed Chair Powell is going to be making remarks after this decision is handed down. What questions do you hope he might answer?
Obviously, we want to know what his thoughts are on tariff-induced inflation, the labor market, because those are the 2 mandates that the Fed will have right now, inflation and employment. Also, what his views are, or the committee's views are for economic activity. After all, second quarter GDP was above trend. It was very surprisingly positive. Earnings came in very strong. So there's a disconnect between this great concern, tariff-induced slowdown, recession, end of American exceptionalism, versus the reality on the ground.
And the Fed is, as you mentioned, they're trying to stick to that dual mandate while navigating the impact of tariffs. And what kind of environment do you think this sets up for investors?
Well, it's a really strong environment to own common stocks. We have tax policy has been solidified, so corporate America has 100% expensing in front of them and starting in 26. Permitting is easing up. Deregulation, inflation, as I mentioned, is trailing lower, and we're only in the 3rd inning of a long AI tailwind. So I think there's a lot of benefits from AI that'll start leaching into corporate America to drive more productivity gains and more efficiency, which will lead to higher earnings growth with less labor costs.
And just to pivot a little bit, big tech valuations are rising. Google just hit a $3 trillion market cap. How should investors be looking at and approaching the tech sector?
Many investors are underweight large cap tech, and we have to look at this as a generational opportunity to invest in a select number of stocks that have global footprints, massive user bases in the billions, and they have recurring revenues and large moats around their businesses. And what we're seeing is a concentration of capital going into these companies because they're generating high amounts of free cash flow. Their operating cash flows are being reinvested, roughly 60-70% back into their businesses to further build out their footprints. So if you look at data center expansion, it's just amazing what the adoption's going to be, is currently, and we really want to be a participant of that. So investors should be invested in large cap tech. We are.
And despite everything that's going on with the economy, like tariffs, these higher rates, the market's pretty resilient. Do you think this is going to continue throughout the end of the year?
I'm sure there's some tail risk event that could occur that might set stocks back, but as a long-term investor, I think there's certain industry groups that are very attractive now. We talked about large cap tech, but there are peripheral companies that benefit from this expansion in AI and data centers, whether it's in the power sector, cooling the data centers, building the racks. There's just a lot of companies that will benefit from the trend that's in place and well-established trend that's only going to be enhanced going forward. So I think it's very important to look at a longer-term view. The market in itself could obviously have short-term pullbacks, but in the end, stocks are where you're making the most amount of appreciation on your capital.
And for investors thinking long-term, do you have any suggestions outside of stocks, like perhaps municipal bonds, where they might be able to invest?
Yeah, we've recently had muni bond yields pop up over 4% tax-free, and they actually hit 5% tax-free about a month ago. So what's interesting is that opportunity to own muni bonds, generate high levels of tax-free income is currently here.
All right, and anything else under the radar that you think investors should be paying attention to right now?
Watch your asset allocation. Stocks have gone up 100% in 5 years, so you may be over allocated to equity, and it might be a good time to trim and add muni bonds at 4.5%.
All right, Richard Saperstein, thank you so much for joining us at the New York Stock Exchange.
My pleasure.